Something strange is happening in crypto. Sure, the market's shrinking, prices are plunging, and major players are blowing up. But I've started to wonder if there's something more we don't understand. I feel like we've kind of hit a bottom in the market, yet every week, another company is laying off even more people. What's going on here? Do these companies know something we don't? And what do these mass layoffs say about the health of the industry and the future of crypto? I needed to find out. The losses in the last year in profits, jobs, and whole companies are reason enough to ask the question, is this the Cryptocalypse? Is this the absolute end of crypto forever and ever?
Forever.
No. Not even close. But things are chilly out there. Since its peak last November, crypto has lost 70% of its total market value. Fluctuations over that time are in the trillions. With conditions this bad, a few companies have already gone the way of the splendid poisoned frog. You've heard the saying, desperate times call for desperate measures. Well, for a lot of businesses out there, both in crypto and traditional markets, these are desperate times, which is why we're seeing so many companies taking such desperate measures, like laying off 20, 30, even 50% of their entire workforce. When it looks like we're entering into a potentially years-long bear market, even companies like Crypto.com are scaling back to the bare minimum, pun intended, in order to survive the long winter. But as the great 7 of 9 once said,
survival is insufficient.
So besides just muddling through this, what's actually the secret to coming out on top? And again, what do these crypto companies know that we don't know? The first thing we need to do is look at who's really responsible for taking us to the bottom and the behavior that got us there. After the utter ruckus of 2020, which saw mistrust in traditional governments, people from across the political spectrum again became more open to the idea that, hey, maybe there's something to this Bitcoin I've been hearing about. Also, a lot of people were just kind of at home in front of their computers, where crypto comes from, looking for something interesting to click on. Maybe it was institutional mistrust, maybe it was boredom, or maybe there were just a lot of people who finally had the time to actually research what a Bitcoin is. But whatever the reasons were, a lot of people bought in, and crypto started to gain acceptance as a legitimate currency, as a potential solution to global and local problems. And as a result, prices skyrocketed across the market. And to be clear, it's not really the public's fault that there was a bubble. Bubbles don't occur just as a result of mass public interest. Sure, that does help, but I tend to think it's more about what a few bad actors, not that guy, more like these guys, did with all that interest, behaving recklessly, believing their own hype, and cutting corners on risk assessment. Many companies believe this sudden expansion was simply here to stay. They took out massive loans, bought even more cryptocurrencies, and expanded their operations, aggressively hiring tons of new staff. Classic bubble behavior. So when all shit popped, not in the good way, these companies couldn't pay the loans, the rent, or the people that they hired. So they took the public hype and they seized it. And when things came crashing down, the first thing to go are those extra people they hired. Why is that the case? And why does it keep happening even though the markets have been relatively flat in the past few months? We need to look at how big this problem is. And I quickly found out it ain't easy to pin down an exact number of how many people have been laid off, especially as some companies, I'm looking at you, Crypto.com, have apparently been underreporting how many people they've axed. But a fair estimate is that across the industry, at least 3,500 people have lost their jobs from big crypto companies. But why are companies doing this now? Well, actually, there's a lot of reasons that companies lay off employees. But in cases like this, it usually has to do with quarterly reports. These reports are a summary of financial statements, like balance sheets, income statements, and cash flow statements, issued by companies every quarter. This isn't just something companies do for fun. Publicly traded companies are required to file their reports with the SEC, but any company with investors is going to have some kind of quarterly report, which is every single big crypto company. And beyond these financials, they typically contain an important set of data called key performance indicators. These are meant to clearly show that the company is meeting its goals and is likely to deliver long-term profits to its investors. See, quarterly reports give a snapshot of what's happening now in the company, but their real purpose is to inspire projections that they'll be profitable in the future. That way, investors are kept happy and their money is kept in the companies. So when KPIs are less than promising, the company's management has some explaining to do to all these investors. And when a company is struggling to make a profit, like in a bear market, they need something to point to and say, hey, at least this thing is good. And typically that means quickly cutting costs now in order to show that they'll make more money in the future. And when they need to cut costs in a hurry, a go-to move is to just let a bunch of people go because it immediately reduces their operating costs. This can be a huge, mega huge chunk of change. CoinFlex, they're a derivative platform, said that the reason they laid off so many workers is that it'll actually cut costs by 50 to 60%. But what about all the non-human assets? Why not sell those first? Again, the key here is speed. It takes time to move into cheaper offices. It takes time to get out of a lease. It takes time to sell assets like stock, real estate, or even office furniture. And at the end of the day, like literally at the end of the day, it only takes about 5 seconds to hand someone a cardboard box and a severance check.
You're all fired. All 4 are fired.
What about the severance check? If the point is to cut costs, but they're still paying people, how does that add up? When it comes to quarterly reports, severance pay is considered a non-operating expense, which means it doesn't have any impact on the company's quarterly net income. Remember, this is all about projections and the look of the company. It's not about what they have so much as what they're going to have. And since severance is typically paid immediately, it's not a part of the company's ongoing expenses, and therefore it can be left out of future cost projections. This is why corporations make a distinction between being fired and being laid off. People are fired because their company wants them out of the office, but people are laid off because their company needs them off the books. You would think that laying off employees would be the last resort in bad times, but the sad truth here is it's often the easiest way to make your company look better to investors. As desperate as that sounds, it actually presents a unique opportunity for companies to establish themselves as one of crypto's foundational brands. You can't buy legacy, you earn it. And the way you do this is by surviving periods of sustained crisis, gaining invaluable experience, and building a reputation as a resilient brand that will last for years to come. This is exactly what investors want. So as short-term a solution as layoffs might be, if it means lasting long enough to become crypto's Ford, Chase, or Amazon, what's the loss of a few workers compared to becoming a permanent brand? Remember, while more than half of all .com companies didn't survive the early 2000s bubble burst, even the ones that did survive struggled, including Amazon, which lost more than 90% of its value. But by keeping it together and doing what's necessary to still be around when times are good again, Amazon is now worth more than the entire crypto industry. Okay, so what's next? This is the question every investor and crypto company is asking themselves right now. How do we make it to the part when things are good again? And the answer isn't exactly sexy, because now's the time for companies to focus on tight budgets and to more or less wait out the storm as it corrects through a phase called consolidation. This means that even though prices can be erratic, over time they simmer down and stabilize to a somewhat predictable range. See, after periods of boom and bust, it usually takes some time for a market to adjust. And by market, I mean people. We're kind of like a cat who jumps up on a hot stove. They're not going to do that again next week. But how about 6 months from now? Maybe they'll test it out. And when they don't get burned, they'll do it again and again, building confidence to eat your rotisserie chicken off the countertop. So over the roughly 6 months of the 2017 crypto boom and the 18 bust, Bitcoin prices stormed up and down with a low of around $6,000 and high around $19,000. Then over the next 6 months, though prices continue to fluctuate, they did so in a much more tranquil range between $6,000 and $9,500. That's consolidation. After that, prices remained relatively stable until everything blew up in 2020. We were cats fearlessly stealing rotisserie. We felt like geniuses until the stove was left on again. And Bitcoin dropped in value by $45,000. But while it feels bad, the price it's dropped to is around $20,000. That's higher than Bitcoin's value in its entire history before 2020. In the last 2 months, through a steady onslaught of bad news about layoffs, fraud, and bankruptcy, as well as some periodic good news, Bitcoin actually held its price for the most part. Now here's the thing, we unfortunately need more time. Our paws are still burned, and this isn't a long enough time period to say for sure that we've entered into a consolidation phase. But whatever the future holds, there are signs that plenty of companies are going to weather this storm. Crypto isn't going anywhere. Just recently, CoinFund announced a $300 million fund focusing on early-stage crypto investments. In March, a new crypto fund, Han Ventures, raised $1.5 billion. In May, Andreessen Horowitz raised $4.5 billion explicitly earmarked for crypto investments. The point is, there's still progress every month, even though it seems choppy and scary from the surface. So if you're wondering what you're probably always wondering about crypto, is this the time to get in or is this the time to get out? The answer depends on whether or not the worst part is more or less over, if we've actually entered a phase of consolidation. Over the next 6 months or so, look for crypto to hold a relatively stable period of fluctuation, probably between 20K and 30K. And don't forget about outside forces. What are the other markets up to? Because stocks and monetary policy also sway crypto. Are there regulations actually happening in crypto? Keep your eyes peeled because things will eventually show signs of relief, and you want to be there to capture it when those things happen. And whatever happens, whoever gets fired or laid off, whichever companies turn out to be a scam or file for bankruptcy, and whether or not good news actually turns out to be good news, I'll be right here to walk you through it.